Good afternoon, everyone. Glad to be here. The topic of the panel today is Dealflow and Deal Execution in 2023. I think everyone knows me from this morning, but quickly, Claudine Cohen, Managing Principal of Cohn, Reznick's Value 360 practice. That includes transaction advisory, our restructuring and dispute resolution practice, project finance, and valuation. So glad to be here. I'm going to let all of our panelists separately introduce themselves, and then we can kick it off. So, Nick, do you want to start off?
Sure. Good morning, everyone. Nick Russell. I'm the managing partner at Tuckerman Capital. We're a private investment firm that over the last 20 years has invested through a series of funds exclusively backing independent sponsor partners based in Hanover, New Hampshire, where I think it's 5 degrees Fahrenheit right now. So I'm very happy to be here.
Hey guys, my name's Drew Brantley. I'm with Frisch Capital Partners. We're a boutique investment bank. We work exclusively with independent sponsors, helping them raise equity and debt for their transactions.
Hello everybody, I'm Taurus Richardson. I am an independent sponsor at IMB Partners. We focus on utilities and government contracting. We've done 8 controlled buyouts, and from a holdco perspective, have $1 billion of revenue and like 700 employees.
Paul Marino, Sadison Goldberg. I run our private equity and M&A practice.
Mark Fornaciero, co-founder of Clarendon Capital. We were founded in 1998. We invest exclusively in transportation, logistics, and distribution. Our first 20 years as an independent sponsor, the last 4 investing out of Clarendon Capital Fund 1. We've seen over a 35% IRR in our 12 investments, and anyone who has a deal in transportation logistics, we'd love to talk to you about being your capital provider.
Thank you. So I think this morning, as I was kicking off the conference, I said in the first time, we've been coming to iGlobal for the past 9 years, and every year it seemed, we've walked in here and the market's just been good. Everyone's been super positive. It's just been a great environment to do deals, and entering 2023, it just feels a little bit different. A lot more cautious. People have different views in terms of where we're going to be, whether it's in Q1 versus Q3, 4. So, Nick, I think I'll kick it over to you and just, if you could just give your brief thoughts on what you think about the market.
Certainly risk is off in the market. I think relative to Tuckerman's strategy, again, we've been investing with the same strategy through several cycles, and I think to some extent have prided our strategy as being a buyout strategy that focuses on risk more than many. We don't use a ton of leverage in our deals. Many of our investments, we do all equity or all securities from our funds, some debt, although we're equity investors. So it's sort of like the adage of when the tide sort of rolls and you see who's not wearing underwear. Like we've always had our underwear on, like fully.
That's good to know.
But, we focus on smaller deals. So my view is, and I'd love to hear from others, that despite the cyclical nature of many and the correlated cyclical nature of many of the activities in the financial markets, as you go down into the smaller market, everything is less leveraged. We're less leveraged to debt. The flow is less leveraged to other macro because there's a big demographic drivers that are driving the sort of supply of deals. So, for all of those reasons, I remain pretty optimistic for our business, but certainly the edges come off, and that should be good for everyone who's trying to invest going forward. So I'm pretty excited about what's coming.
And Drew, what about you?
Yeah, I think it's interesting because if I think kind of at a macro level, and I'm sure everybody's kind of seen similar things of what I'm about to say, but if you think about coming out of 2020 COVID, the second half of that year, deal flow really started to pick up, and then 2021 was just, hold on to the wagon as it was flying down the hill as fast as it could, and then going into 2022, we kind of rode that wave starting out the year, but then when the Fed started raising rates, and a lot faster, I think, than anybody anticipated, it started to put the brakes on the market real quick. I think faster than most of us saw. So the first half of last year was great. Valuation's good, deal flow good. Second half of the year, deal flow came to a halt for some people in certain parts of the market or certain industries that were potentially more cyclical. Others, I think, still flowed, but I think, the issue was that sellers and sell-side investment banks were kind of reeling from wanting to be valuations, from the year before, but all of a sudden now dealing with the reality of interest rates rising, leverage coming down, people underwriting deals differently. So I think for those of us that are working, buying companies or raising capital for companies, I think valuations are starting to stabilize a little bit or come down depending on the industries that you're in. And I think a lot of people waited on the second half of last year to come into the market to kind of see how the year played out. And, I don't know what people in the room are seeing, but I think so far this year, I've heard from multiple people they've seen more deals in the past 3 weeks, than they did in all of Q4 last year. So I think the deal market's starting to pick back up. People that waited to get into the market are coming back in. I think the Fed yesterday making the move that they did helped add some optimism to the market. I think recession's still a big concern for a lot of people, so people are absolutely thinking about risk like Nick was talking about. But I do feel like it's starting to turn a corner a little bit from where it was last year for
It's
us.
sort of the difference between expectations and reality, right? Like, it
Yeah.
doesn't matter where reality is. It could be good, it could be bad, but if there's a
Absolutely.
gap, it's hard to get stuff done.
Yep.
As long as expectations and reality are close, we can do stuff.
Absolutely.
That was Drew's short version of he's optimistic for this year.
Yeah, and I am optimistic
You
for
should
this
be,
year. I mean,
yeah.
we're in the market with stuff, and we like what we're seeing. My point was, it slowed down last year. It's picking up this year. 4 words, sorry.
We're good friends, right, Drew?
I'm optimistic about the market. We play utilities and government services with a focus on sort of military, food, IT to government contractors, and electric and gas utilities. And those sectors have all grown over the last 4 years. So we have a net positive, sort of EBITDA and revenue growth across the portfolio. And so when you're not busy restructuring or sort of fixing businesses, you get to sort of sit and, be more active. We closed 2 deals last year, one in March at a $100 million enterprise value, one in November. We came out the gate under LOI in the first week. We called 2 people. We sort of like go back against deals that we saw that didn't close. And 2 deals got stuck last year that we hope to chase. And hopefully to be under LOI in the next week or 2. And so I feel like a lot of things for us when markets are choppy, when people are nervous, is the greatest time for people who have a strategy, not a strategy, but a focus on being comfortable with a little bit of choppiness in a revenue or EBITDA line, but have a long-term view on what the asset can do. And so this is the most optimistic I can be, which is when people are a little nervous, it's time to make money.
I love it, man. So from my vantage point, right, I mean, as a law firm, we're kind of lagging indicators, right? Because we have deals in the pipeline that we're closing, when things kind of go sideways, we're still closing those deals because people are generally committed to closing those deals. It's really pipeline. So, to Nick's point, like, you saw the pipeline start to dry out third and fourth quarter last year, and it's definitely picking up. But, for the larger part, and a lot of this depends on where you sit. Like, we're a middle market law firm, so we see higher, larger deals and smaller deals. And a lot of it depends on where you sit in the capital stack. So if you're a high-end guy, if you're a high-end fund or you're doing deals at 500 million plus, the prediction, it's like Mr. T from Rocky III, it's pain, right? And because you're not getting the capital, people are kind of pausing out and they're waiting because their cost of capital is much higher than they modeled out for a lot of these deals. For the smaller deals, they're the ice dam is breaking. And I'm very bullish on it because sentiment controls, and most people in this room want to do deals. There's a kind of a come to Jesus moment for a lot of sellers, and there's 2 types of sellers in the market that most of you guys deal with. It's the younger guys that can kind of wait out, and I'm just going to wait this out. I'm going to wait this out, and they're hoping that they're not catching a falling knife. And then there's the older, folks who don't have anybody to push their business to, that want to get out before, valuations keep get lower. So I think that tamp down in valuation is a huge help for most people in here, and so I think we're going to kind of see a little bit, and I hate to say because it's kind of like the green shoots back from the GFC, but you're going to see a dip and rip, right? So you're going to see a dip down and then a rip into the market. So I would say probably, I mean, for what it's worth, maybe, September, October, you're going to really see a lot of deals start really rolling forward.
Yeah, we have found that times of uncertainty are a great time to do deals. We did one deal in April of 2020 and then another one in May of 2020. Our banker told us, our senior banker said we're the only deal. They usually have about 30 deals they're looking at, and we were the only one back then. I think, we just got one under LOI about a week ago. I think if you're the kind of capital partner that really can be a partner and you find a business where they want to take some chips off and have some safety, but also is willing to be a partner through things such as earn-out, roll forward equity, and you can find a way to figure out over the last 2.5 years how much of their business uplift has been just a huge tailwind, which in transportation, logistics, supply chain, there was a massive tailwind, and how much was a real improvement, sustainability in the business, and we feel that's where expertise like ours can come into play, and I'm sure that's true with a lot of the independent sponsors in this room. And then you come up with a structure that's tailored for the situation, share risks, share upside, and it can be a fantastic time to get deals done.
And I know from talking to several investment bankers, a lot of them are telling their clients, just hold back, no rush to get to market now. Historically, a lot of independent sponsors have sourced proprietary deals. I mean, that's been part of the model, the time, the patience to go and look for those deals. But more recently, independent sponsors have got into the mix in competitive processes and that. So, what do you think, just hearing that in terms of deal flow, do we see more of a shift back to sourcing those proprietary deals in the Q1 and Q2 of this year versus, relying on some of those bank processes?
We've always looked to do all 12 deals we've done on the platform side have been proprietary or with an independent sponsor. We've had independent sponsor partners on 2 of our last 5 deals. And that's another reason we kind of like this market and uncertainty. We think owners are more willing to really sit down, get to know a capital provider, can be with an independent sponsor, and we love to do it that way. And you can really craft something that's bespoke and customized to the situation. We've always had challenges personally getting into a very competitive process for a platform investment. It just doesn't give you, in our view, the time to really get to know the ownership. It's hard to customize something. We love, for follow-on acquisitions for our platforms, we often do shop deals because we can get synergies. But I would agree, I think it's a great time for an independent sponsor to find an interesting proprietary deal where they have value add and they can take something and find the right capital partner for themselves, which we hope to be in anything transportation, logistics. Sorry for the second commercial.
Go ahead.
It's hard to follow. I was trying to figure out how to work in some Mr. T reference, but I'm not there yet. I pity the fool.
You pity the fool who is...
For Tucker, in terms of the proprietary deal question, the very reason that 25 years ago or more, my partners who founded Tuckerman, and why for that period we've trafficked in this independent sponsor space is because I would argue a role, and there's all different kinds of deals and folks out there, but a great role, the reason for the development of the independent sponsor is to bring some efficiency to this sort of inefficient end of the buyout universe, where there's, in the efficient end, there's really great investment bankers who run super efficient processes, and it's a little harder to do that in a risk-off period than in a risk-on period. But at the inefficient end, there's sellers who, everybody cares about price, but on their sort of conjoint choice exercise of like, what do I really care about? Independent sponsors are never going to compete with a big funded fund on certainty, apples to apples, and they may struggle because there's more cooks in the kitchen to compete on price. where those are the number one, again, all of these things are important to sellers, but where those are the number 1 and 2 factors, and they're far ahead of the who's my partner, I care about who's going to own this business, what's going to happen with my business afterwards. And we've seen that those conversations, usually in less well intermediated or less efficiently intermediated transactions, are where independent sponsors excel. So I guess it's a way of saying, yes, I think the opportunity is probably greater relative to folks being able to sort of realize, if I need to sell, I'm going to, run a process that's not going to be super efficient, and we're going to have to, run a process that may be better suited to finding the right partner, and I think that'll give a relative advantage to independent sponsors. I would also say, maybe something that Mark was alluding to, I would not understate the psychological impact and clutter of sort of coming out of COVID. We all want to put COVID way in the rearview mirror, and it was a tough time for people, but for business owners who went through that, PPP loans, a lot of people had extraordinary volatility and dealing with things they've never dealt with, and now sellers are sort of staring down macro, the fright of a potential all the macro stuff that's going on. There's just a lot of emotional clutter in that for a seller, and people are going to have to be pretty motivated, I think, to want to go into a sale process. They're going to be pretty motivated to actually get stuff done, hopefully. But again, just to try to be more concise, hopefully more proprietary deals, yes.
So, real quick, I want to add something, I think, to what Nick was just saying and Mark. So the way we think about it, too, is for independent sponsors, they have a unique advantage to us over funded sponsors sometimes when talking to sellers. And one of those things is time. And 2 is they don't always come with a label and a fund. And a lot of sellers, they have a stereotype in their head of what, quote, private equity is, because they lump everything into private equity regardless of who they are. And so they think of Richard Gere back in Pretty Woman, and they're going to come and slice and dice their company up and, butcher their people and the business and their legacy. And people don't want that. And they want to sell to people that they trust or they like, or they believe are going to be a good steward, kind of to Nick's point. And that trust piece is one of those things that takes time to build, and where we see a lot of independent sponsors really excel, whether it's a proprietary deal or in a process where somebody just invests more time, is when they spend that extra time building that relationship with those sellers. And then those sellers, while yes, the money is important, to Nick's point, it's not always the motivating factor for a lot of sellers. And independent sponsors, where we see them excel all the time and get deals, and candidly, I'm just going to say it, there's a lot of funded sponsors that call us and they go, how the hell did this guy get this deal? There's no way they should get that. They don't have the money. And we're going, well, they spent the time to build that relationship with the seller, and they wanted to sell to him, and that was important. And so to us, that's one of the silver bullets that independent sponsors have.
So how does the as we look forward, how do you think that, do you agree with what I was saying about sort of in a macro environment that's sort of muted, is that an advantage to this community, or it's neutral? What do you?
I guess I always think it's an advantage. I do think people have to be motivated to sell, but I think kind of in this part of the market, the motivations for selling in the lower part of the market, I think they've shifted for a lot of people over the last 5 years. I think COVID brought this perspective of, a black swan event that a lot of people never thought would happen or weren't thinking about, and so they weren't going to sell, but now all of a sudden they're like, hey, maybe I should think about selling.
Yeah, it's like anybody, if you bought a stock at 5 and went up to 100, and now it's kind of trending back down to 75, 60, you still made a lot of money on it. Do you want to blow out of that stock now? And it's the same mindset, right? So now I could have got 100 2 years ago. Now I might have to do an equity roll and an earn out or something else, right? And maybe now is the time. I want to get out of this now. And a lot of that, look, you guys know this better than me, but I see it from my side of it. A lot of that is who the seller is, right? And you got to gauge that through. Is it somebody who's kind of towards the back end, the back nine, and they just want to, they want to get out? Is it somebody who's younger that says, you know what, I don't care, I got a long, I'm only on the 5th hole, I got a while to get to the turn, and you can see I like golf a lot. So, the truth of the matter is that to me, again, sentiment controls. It controls the market. It controls everything we do. That's why we're human, right? And to that point, people are going to make that decision, and At the next point, I mean, if the market is muted, right, and people hear recession, does that spook them? I mean, I don't know, because I think if somebody wants to sell and they're looking at it like, boy, if I don't sell now, I may never get this price again. And if they, and you have to make that determination as to who your counterpart is and then how you're going to deal with it. And the last point, it's funny, private equity guys, definitely, they used to have they used to have so much leverage over independent sponsors. I mean, and now it's to me, it's almost like the script is flipped, right? Because a lot of sellers care a lot about the people that work for them, and they care about a lot of what they've built. And they feel like PE is going to come in with these cats who never worked a day in their life outside of an institution or outside of running spreadsheets or what have you, and then you have some independent sponsor that might have been in the trucking business or that really understands operations, and they come in and they'll stay on board, and and I think that's a huge selling point. I mean, a huge selling point. We see it. One of my colleagues is here. We see it all the time, and we just saw it in the trucking deal we just did.
Yeah. I think a key. I'm sorry.
Yeah, I think just from for the independent sponsors, step one is some version of you got to have sector specialization, because when you get in front of a founder, they got to see why you make sense to be their partner. And when you're short chip stack, you at least got to say, I love utilities. This is what I've done. This is why I make a good partner to you. And they are selling their family business or a founder-owned business, and that makes the case. On the proprietary side, you got to have a reason to believe you have proprietary deal flow. So for us, we're starting 3 buy-side searches where we've hired, retained buy-side search. They will touch 100, 150 people in a corrosion sector, a transportation or transmission and distribution utility sector, and in a food sector. We will touch 400 to 500 people this year, and we'll keep touching them. And that's just the 2023 batch. And as you go back and say, okay, we touched X number of people in 20, X number of people in 21, you're just planting seeds, and that's how you create the proprietary deal flow. And then lastly, if you're short chip stacked, I don't have the large balance sheet, you got to buy someone with a limp. My limp has been either customer concentration. We bought 6 of the 8 businesses have had 1 customer. Most people avoid that. The other 2 have had either a small business, woman-owned business, minority-owned certification. Most buyers avoid that. And so if I can't find a reason why the average buyer is going to walk away, or why I have sector specialization that'll make me a likely buyer, I let other people do it. And that's how you create unique deal flow, if that makes any sense.
Yeah, I just want to sorry, Nick, did you want to say?
I was just going to say, one of the interesting indicators, and so our business model is about getting calls from independent sponsors and then quickly getting to conviction to back them. And as the community has grown, there's a lot of those calls. I think we've come through a year-and-a-half period where we literally wouldn't engage with someone if they were in a process where there was a banker and they didn't have an LOI, because we just knew, we saw it every time for a couple of years, like somebody's going to blow you away on price in this process. And in the last few months, we've seen people who are in those processes, and our intuition was to say, somebody's going to blow you away, and then they've actually gotten to the LOI as an independent sponsor with a brokered or a bankered process. So it's just sort of an indication of like, hang in there.
So do you like deals that have bankers on them or not?
We prefer well-priced deals. I don't care if there's a banker on it or not. In
little
risk
bit
on
of a
markets,
banker
we're not
helps.
going to get there on like an efficient price. We want
Yeah.
to buy things at inefficient prices.
A little banker helps because the seller has to be educated, and by definition, they don't trust you. And so having an expert in the middle is helpful. Having an expert in the middle that's sending it to 1,000 buyers, not so helpful.
Yeah.
That might be a different
my experience
panel.
as an attorney on it, I will tell you right now, I'd love a banker on it, only because they have, most of these guys who are sellers have never sold before. And the banker really kind of, it's like, this is like, we've had people like, they're arguing indemnification, and they take it personally. And like, no, it's nothing personal. It's just,
It might be a different panel topic. We want to make sure we stay on
So
scope,
I
but like the
just
perils
trying
of
to,
proprietary deals, that's a good topic. iGlobal, take note.
I'm trying to move this along. So as we think about deal execution, I know everyone wants to talk about sourcing the deal and banker, no banker, proprietary. So Just as you think about deal execution, we've just come out of this crazy environment. I mean, I can tell you from our standpoint, client calls you up, just signed the LOI yesterday, doesn't want to run our work in parallel. I mean, doesn't want to phase anything in the diligence. It's just like everything is running in parallel. Business, commercial diligence, financial, tax, legal, everything. You're just scrambling, to get that deal done. Do we think that changes now? And does the just getting those deals done, is that going to look different?
I think so. I mean, again, I think the aperture to phase and sequence activities through a deal process, which disappeared at least in brokered or banked processes for several years, I would argue has opened back up, and we're selling some things now, and our sell-side advisors on those are like, have come off of, hey, we can run 7 parties, under, no exclusivity to the end and make them all do their work. They're like, yeah, that's not really, again, it might be a different panel or a different speaker because I'm not a sell-side banker, but certainly those processes will change, I think, and go back to what frankly, what I would argue is healthier for buyers and sellers. Maybe it's not healthier for sellers because that's a seller's market versus just like a more level, rational process.
Part of it, I think, too, depends for independent sponsors is how much risk they're willing to take on from a dollar perspective, from a third-party due diligence perspective. So I would say a lot of our deals, it is staggered just by the nature of they don't want to commit to too many dollars on too many third parties unless it's necessary. Sometimes you need to do it because you need to, dig into something financial, or you need to uncover something, billing and coding in healthcare, whatever it is. So you need to do certain things, or you need to do it for a seller. But if they can not do that, get more alignment and conviction with a capital partner, and then stagger those things in, I think to Nick's point, there's a certain element of that can make the deal, I guess, arguably a little more healthy as you go along, versus kind of running 12 things in parallel, and then one of them falls and the whole thing falls apart when you could have staggered it a little bit more. So, but I think the cost drives that a lot. We see that good market, bad market. We don't necessarily see that changing a ton for us, maybe a little bit, but I would say for a lot of our clients, they've been cost conscious to begin with, so a lot of it's been staggered.
I think one thing that makes things harder, but is also an opportunity, is you really haven't had a normal year for 4 years since 2019. And so I think, as an independent sponsor putting that hat on, as a capital provider, you really got to think about what is sustainable over what's happened over the last 4 years as you think about valuation, and getting comfortable that what you have as what you're backing as an independent sponsor is something that you have a normalized what the real opportunity is, X the tailwind, so you don't end up spending a lot of money on a Q of E and go down a path and then realize what's there isn't sustainable. So one thing we look at is trying to go back in history before 2020, just to get a sense of how the business has grown, try to think about what sort of tailwind aspects may have impacted results. And if you can do that kind of homework before you have an LOI, if that's possible, or early on, that can reduce your risk a lot in broken deal fees later, where you find something out after you've already spent a lot of money.
Yeah, I mean, no one wants to pay me, right? So at the end of the day, right, you think about it, nobody's raise your hand if you love paying your attorney. And so, but yeah, thank you, I appreciate you. But I will say, look, I mean, when you sell a house, right, I mean, and again, I mean, just to break things down into very simple terms, when you sell a house, curb appeal probably, if the house looks nice on the outside, you probably juice up the cost of your house maybe 10%, right? I mean, or 15%, I don't know the exact number, but it's high enough. So when we're on the sell side, and before somebody goes out, and they get their sim going or whatever it is, we always tell them, get your house in order now. You'll increase your cost. You'll increase what you get dramatically, right? And it's not, because it looks like you know what you're doing. And most family-run businesses, they start off, they have like a deli mentality. I'm coming into work every day. I got to turn the lights on. This is what I'm going to do. And then they start off that way, and then they build, and before they know it, they have an enterprise of $250 million, enterprise of $100 million, whatever it is. And, but they still have the same mentality. So, they have their cousin in bookkeeping or whatever they're doing. And, when a professional buyer comes in, it's very sloppy looking. So if you can bring in, and get almost a mock Q of E, right, and get your house in order beforehand, you really do, on the sell side, you really do increase what you're going to get, the value of it. And you're more trustworthy, right? And nobody likes a seller that feels like it's, right, untrustworthy. So.
How do you feel about the structure of deals in this environment? COVID, in the early part of COVID, I think 2020, people were talking about these earn-outs and, seller notes and all those things. And I feel we're going to come back to that and maybe more. And I don't know.
We've seen some really idiosyncratic structures recently and stuff that you would sort of like, just odd things. Were good and interesting and attractive, but that you never, you see once in 15 years of doing this or 20 years of doing this. There's a lot of factors that go into that. Most of them are idiosyncratic to a seller, to a seller who's willing to do something kind of crazy. Not, in our view, not so much to sort of like buyers willing to do all kinds of crazy stuff. Because as buyers, we generally, and I think most people are sort of like, hey, keep it as simple as you can, and then if you need to be innovative, you can try to be innovative. But I don't know. We've for example, sellers who just don't need the dollars, but who are willing to roll substantial amounts into the deal because they just want to get the deal sold in debt or in equity. I think the debt markets also have a lot to do with it in what we're seeing because, again, if the price of senior bank debt approaches double digits, I think it's still in single digits, but it just doesn't, on an absolute return, sort of risk-return basis, if you can sort of as a seller receive that type of return on relatively low risk dollars, where else are they going to put it? I mean, that's a good, in the grand scheme of returns, if you can get 9% on some senior security, it's not rocket science to say, hey, that's for a business that and have run for 20 years, that's sort of an interesting return. They've got to put it somewhere.
And where we are today with just the current interest rates and the blended rate that you'll pay with senior or unitranche, mezz, whatever it is, how many turns of EBITDA has that translated into versus where we were a year ago?
On an enterprise value?
Yeah, as you kind of look at it, if something was
I think
going at
on
9 times,
senior,
7 times now?
let's see. Well, senior debt, we've typically done at 3 to 4x, but we haven't used mezz on our deals. We use it potentially later on if we do add-on acquisitions rather than put more equity in. I think it's come down about a turn or so over the last 7 months from what I'm told as we go into this LOI process. Getting to your earlier question, I think you are going to see, I don't think there was a lot of, personally, I don't think there was a lot of benefit to seller notes the last couple of years because debt was so attractive, so you didn't really need the seller to put up a seller note. I think now, as Nick was saying, it can be attractive for the seller and the buyer to do some seller financing. I think earnouts, for the same reason I said before, it's very hard to know what I would call true sustainable earnings have occurred over the last 3 years. And so, we get comfort in earnout structures where we're sharing where we can give an owner some upside if they're generally more optimistic view of what sustainable occurs. And that can be a good supplement to roll forward equity and option programs. So I think you are going to see a lot more structured deals, and we like that because that's something that we think can align ourselves with the capital provider, the independent sponsor, and the seller of the business.
Just on the multiples, I think if you're lower middle market, 3 to 10 of EBITDA, it's the same. It's still 3x4s with room for a revolver, so funded at 2.7 or 3.5 to 3.7. It hasn't changed over the last 24 months. The cost of capital, if you've been in the business for a while, you're still borrowing senior debt at below 10%. Unit tranches are pricing at 10 to 12. Most LBO structures work at those rates. And so it hasn't caused the dislocation in the lower middle market that you see is happening, where you can't borrow on a, $100 million, $300 million, $500 million facility. That market is stopped because of syndication issues.
100%.
But in the lower middle market, you're taking mostly a single lender hold at 25 million or below, or maybe a partner, and it's open for business. And on the rollover stuff, I do all deals on a partner basis where 20% of the enterprise value typically is rolled over. And it helps me with a low chip stack. I don't have as much money to put in. I must get rollover from a seller, otherwise my model doesn't work. And when you're having a seller roll over a meaningful amount of money, that earnout thing doesn't work as well because it misaligns interest. And so out of 20 deals, I've never done an earnout because I don't want to be on the wrong side of my partner as much. I'd rather give them more upside and we row in the same boat versus trying to use a structure where in 12 months, 24 months, we're on different sides of the boat when I really need that partner to be with me on an everyday basis.
Yeah, I mean, we see so many deals. I couldn't agree with you more. I mean, the earnout, I'm not, people get squirrely about earnouts. As long as you can achieve the earnout, it's a good earnout. I mean, if it's smoke and mirrors, it's never going to work out. I mean, it doesn't. So, you got to be true to yourself, and you can't use it just to hook somebody in and then reel them in. Because, and especially if somebody's going to stay on board, right? I mean, if your team, the seller team is going to stay on board and your earnout is squishy, I mean, there's going to be problems for you down the road. That's the worst. I mean, it's like a bad divorce waiting to happen. So that's one thing. The second thing is I agree with you. Lower middle market, I haven't seen, much of a difference as far as financing goes. And then lastly, the rollover equity is, I mean, a few years back, you rarely saw it. Now you see it all the time, and especially with a younger seller, because they want a second bite of the apple, and they believe in the equity component. And to me, that's the home run.
I think my question was more, that if we're looking at a deal this time last year versus today, all other things being equal, if that deal was trading at a 9 times last year, to get the same returns and for you to have similar economics, does that business have to trade at a 7 times today, given where we are with debt? I think that was more my question.
I mean, like the cost of capital for me has gone up by 300 basis points. So we're pricing at 400 or 500. Now we're pricing at 600, 700. That's not changing the price enough, right? Most of the $3 to $10 million EBITDA businesses in what I consider to be 3 to 7% top line growth industries, they've been priced at 5 to 8 times. They're still priced at 5 to 8 times. And if you're in stable industries, if you're in cyclical industries, I don't know. But if you're in a business that's stable or cyclical, if you're selling an electrical contractor or IT or a cybersecurity business, pricing has pretty much been the same, even though your cost of capital has gone up 300 basis points.
Yeah, I think the end markets and the potential cyclicality drives structure. So we're seeing, for certain industries that have the potential to be cyclical, capital providers want to see some skin in the game so they're not going to get caught with their pants down buying something at 8 times and then it dips for the next 2 years. So we're seeing for certain industries a lot more structure than we were, 12 months ago, for that reason, is either a way to bridge valuation gap and or keep people tied to the business and incentivized. I do want to echo, though, what Paul and Nick and everybody were saying about the earnouts. We think earnouts can be a good tool, but keep them simple because people can get their feelings hurt really bad. And if you're trying to screw somebody over on that, make it to where it's impossible for them to get it does not create the alignment you want.
Yeah, I'll say I am a fan of earnouts if they're structured properly. I think, and I totally understand some hate them and think they misalign. I personally think it can help an owner get to, let's say, a valuation they want, but take some of the risk to get there. If it's structured well and you're both going in eyes wide open that, hey, maybe your business is worth a little more, maybe it isn't. It'll be proved out over the next couple years or whatever the earnout is, or not. Either way, we're still locked. We got our collective rollover, we got options, and this money may or may not come. I think if you set the expectation right, it can work. That's our experience. I know many hate them for various reasons, and it's great to have a good debate on things once in a while.
Yeah, because traditionally earnouts has been like some Rube Goldberg contraption, right? Where you have to like hire somebody to figure it out, and
Pull
it
the
shouldn't be that
abacus
way.
out.
Yeah.
I've seen them in a legal agreement. I don't know if they're ones you drafted for, but it's like, what the hell? Like, what
That was
what
probably
is the
Bob.
actual
Bob probably
number here?
drafted that
Like-
one, not me.
Anyway, we are out of time, and I do want to take some questions, if there are any. So I don't know if anyone has any questions. There we have one, yeah.
He's got a mic.
Oh, you got a deal for me? Terrific.
So
This conference has already paid off.
there you go. So an interesting aspect. So there's been a lot of tailwinds when it comes to the market and need for transportation services. There's been a lot of headwinds when it comes to getting drivers, right? So you're having that kind of dual conversation with the current owner when you're determining what the actual potential for that business is versus where it was 2 years ago. So where do you see the driver market, and how do you handle that conversation with them?
Well, the good news for the driver market is we've gone from the tightest market ever, and I do mean that. In 30 years in this business, it's never been tighter than it was in the 12 months leading up to 9/30. And it has shifted dramatically to where now it's actually it's actually loose. Part of that is the part in the cycle. I'd always, if you're a business owner, you always want to have tight capacity because you'll make a lot more money on whatever capacity you have. The challenge is to get more of it. But if you're good, you'll find ways to at least keep what you have stable or build on it. The challenge is, how do you value a business that just went through an incredibly tight period, and in our view, our personal view, the margin that a company was able to get on their driver base in the last 2 years ending 9/30, that's just not going to be sustainable. So how do you come to what's a true fair valuation for a normal market? We always look at it, what's the normal market? And we'll pay a great multiple in a tailwind on the last 12-month earnings, and probably not so great on a huge run. So, but I'm happy to talk with you about that offline. It's an interesting question.
All right. Thank you, everyone. Thanks to our panelists, and see everyone a little later.